Anyway, so now I hope you all can see the screen. I was saying this task 1 and 2 has got statutory financial statements, and the statutory financial statements are SOPL, which is the profit or loss, financial position, statement of changes in equity, statement of cash flow. Um, Statement of changes in equity is almost a certain question that you get. Statement of financial position or cash flow, a statement of profit or loss, and changes in equity. So you could get a mix and match. There is no guarantee that you will definitely get a statement of cash flow. Some people get it, some people don't get it. But if you get it, people really get almost full marks if they when they get cash flow. But then obviously it is all your luck on that day. The next question is reporting framework. So qualitative characteristics of useful information, IFRS conceptual framework. This is all about whatever you have done in level 3 as well. The different characteristics of useful information. It is like the accurate information, financial information, which takes accuracy, complete, correct. Uh, I'm sorry, timely, relevant, and those sort of information. So it should be relevant. So all enhancing qualitative characteristics and qualitative characteristics. So all these you have already learned in level 3 in business awareness. So you will be asked some questions on that. And IFRS conceptual framework, the reporting standards. So this is more a theory question. The next one is task 4, which is 12 marks based on international accounting standards. It is a combination of calculation and written elements. Now, there are so many topics covered in this. Again, you could be asked to write definitions of what is an asset, what is a liability, and those sort of simple things. And you are supposed to know other bits and pieces here. So there are topics which you have to cover on international accounting standards. So there is IS 16, 38, 36, and IS 2, which covers all your assets. Now, why do we need these international accounting standards? These accounting standards are used to prepare the financial statements. Okay, they can be standalone questions in terms of small questions, but in when you work in a company, if you work for a chartered accountant, if you work for a firm, accountancy firm, you would realize that all these are in combination. You have to use them because in workplaces you don't have to do them separately, but then you'll have to use them in conjunction with your task, the actual task. So here in your exam, there will be one big question where you will be asked some of these things, not all of them, but then there will be standalone small questions where these topics can be covered. So it is a combination of calculation and written elements. It could be you will be asked to calculate, and then you may be asked to write something about that, write or like analyze or those sort of things, or calculation, explain why, and those sort of things. So what are the different international accounting standards? It is about property, plant, and equipment. Again, depreciation comes under that. Revaluation of property, plant, and equipment comes under that. Intangible assets, IS 38 comes intangible assets. Intangible assets are goodwill, those sort of assets, patents, uh, copyrights. These are all assets which you can't see. They are intangible. So how do you treat them? So all comes under IS 38. IS 36 covers impairment of asset. Impairment of assets is basically like depreciation, but for intangible assets because they lose their value. Impairment of assets. So how, if there is an impairment, if the assets lose their value, how do we record them? It is on IS 36. IS 2 is all about inventories, which we have covered in level 3 as well. Um, and the next part is task 4 continued. So this is more on the liability side of things. This was more on the asset side of things. This was more on the liability side of things. So IS 12 teaches us or mentions about the rules about the taxation. IFRS speaks about the lease. So when an asset is bought on lease, so if you think about planes, these airline companies, when they buy these flights on lease, or these lorry companies, logistics companies which buy these lorries on lease, how do you record them? Provisions, contingent liabilities, and contingent assets is covered under IS 37. So if there is a provision, if there is a contingent liability, if there is a contingent asset. So sometimes what happens is, if there is a court case going on, and like let us say somebody gets injured in a gym, and that person sues that particular company for not keeping the things, stacking the things correctly, or not having a good floor, or a slippery floor, or somebody slipping over. All those things are kind of provisions, contingent liabilities. And if something is expected, if the company is expecting some compensation, then it is a contingent asset. So those things are covered under IS 37. IS 10 covers events after the reporting period. So if the reporting period is 31st March, there could be events after the reporting period. There could be a merger and acquisition happening after 31st March. I'm taking an example as a March 31st. There could be a scenario where there is a fire in the organization, because of which the inventory gets damaged. So all these things are the events after the reporting period. Sometimes these kinds of events are known to the business, and sometimes the events are not known to the business. So what do we do in case if the events we know beforehand, and in case if we don't know, we have no idea about these events? How do we treat them? Next one is IFRS 15, which is revenue from contracts with the customers. So how do we record the revenue from contracts with the customer? So sometimes what happens is, let us say the company is giving a package deal like a computer with a maintenance contract, a computer with a software. So how do we record the revenue? That is covered under IFRS 15. Task 5 covers drafting consolidated financial statements. So this is quite a chunky one if you see. It consists of 30 marks. Students, most of them do get this towards the end. So if you practice enough, it is very good marks. It is, and it is you could either get a consolidated statement of profit or loss, or you could get a consolidated statement of financial position. So you could get either of them. Okay, but profit and loss, even if you get, it will be a smaller question. Financial position will be a larger question. Task number 6 and 7, interpreting using financial ratios, 30 marks. This is 30 marks. This one was 30 marks. This one is 30 marks again. Financial ratios. Okay, 6 and 7 put together is calculation and interpretation. So what are the different ratios? You'll have to learn them. Are the profitability ratios, efficiency ratios, liquidity ratios, financial position ratios. So all these ratios have to be learned by heart. Unfortunately, you'll have to remember them. Okay, but then they follow like a trend. Profitability is all linked around the profit. So you'll have to see how profitable the company is. What are the sales in compare? What is the profit in comparison to the sales, and those sort of things. Efficiency is about how efficient is the company. So it is all on those things. Liquidity ratios is like current ratio, or how liquid is the company. What is the meaning of how liquid is the company? Do they have enough money? How is their working capital? Do they have enough money to pay their creditors? So that is all covered under liquidity ratios. Financial position ratios is whatever ratios are derived from the statement of financial position, the numbers from the financial position, that is called as the financial position ratios. So these are task number 6 and 7. So this could be, again, like we say, calculation and interpretation, because when you calculate the ratio, that one question will be there where you have to interpret whether the company has done better, whether the company has done worse. Why do you think it must have happened? The profit margin has gone up, profit margin has gone down. What could be the reason for the profit margin going up and down? So those kind of things will be covered on this particular topic. And then there is so these are the different tasks that 7 tasks. So this is about the review. Yeah. Now today what I'm going to do is, like I said, I have picked the most difficult topic which the students really struggle in the exam. And unfortunately, like I said, because of the lack of time, I will not be able to cover the entire thing, but I'm going to try my best to pick certain elements. And what I think from my experience, the students don't have enough knowledge about certain things, that also I'm going to cover, and then followed by a question which I will upload on the Facebook in the files area after the lesson, or maybe tomorrow. Okay. So this is the end of the overview of the exam itself. Now I'm going to show you the types of capital. Now, so to start with consolidated financial statements, there is a topic called company finance. So the students usually, see, I'm not generalizing this, but then students are, some students are aware of this, but some students are not aware of this. So I thought maybe let me just have a, like, just give you a brief about what is company finance, because there is a topic as well on company finance, though it is not asked directly in your exam, but it is good to know. Okay. So there are two types of capital which a company can raise. Yeah. So I'm sure all of you know this. A company can either have borrowed capital or it can have owned capital. Okay, so what is borrowed capital? Surely, as the word says, borrowed capital means the company borrows money. Borrows money from who? From people, not from not from companies, not from banks. That is loans. That is different. Borrowed capital is the capital which a company borrows or takes as a loan from people. People like us, we can invest. So you might have heard about these cash ISAs. You might have heard about ISAs, the SIPPs as well. You might have heard about that. So what is that? The companies you invest in, they invest in different companies, different shares, different debentures, bonds. So they invest in that so that then we are safe. So those companies take that responsibility of investing our money. Okay, so what is borrowed capital? Borrowed capital is the capital which is raised by a company through different, they are called debenture holders or bond holders. So people like us can invest in them and we can get a fixed rate of interest. So it is more than the bank rate of interest. So if you have money, if you save, you are hardly going to get it. Whereas if you invest in a different company's bond, you can get a fixed rate of interest. So that is like a fixed income for the investor, and for the company it is like a fixed cost, it is like a fixed expenditure. Owned capital is equity shares, preference shares. So you might have heard about the shares and stock ISA. You might have heard about that. So what is the shares and stock ISA? So who are these shareholders? Shareholders are also called as equity shareholders, or shareholders are also called as the owners of the business. So if a company ABC Limited wants to raise £100,000 and each share is £1, then they will issue 100,000 shares because each share is £1. So they are going to raise 100,000 shares. Okay, so that is called as a share capital. So share 100,000 people or 100,000 shares. So let us say I want to invest in 500 shares. So I'm going to invest in 500 shares. Somebody else wants to invest in 1,000 shares. They pay £1,000 to the company and they invest in 1,000 shares. So in return, what am I getting? So first of all, the company gets their money. The company is getting that money so that they can diversify, so that they can expand, they can use that money instead of a loan. Second thing is, it is called as, so shareholders are called as the owners of the business. So shareholders are called as the owners of the business. Okay. So if I have bought some shares in the company, I am the owner of the business. Okay. I have got every right to vote within the business. I've got every, so the company has to hold regular meetings to be able to declare a dividend as well. So I'm the owner of the business. So what is it that then the company, how does the company have an advantage? So the company does not have a fixed cost towards the shareholders, unlike the debenture holders. So the debenture holders or the bond holders, they are like the borrowed capital. When you borrow something, they have to pay a regular interest. Whereas this owned capital, these are the people, they don't have to pay dividend every single year. If the company makes a profit, if the company makes a decision to give a dividend, it is their choice whether to give a dividend or not. It is not mandatory to pay the dividend. Then in that case, what is the advantage for me, for a person like me, me investor, me and you guys who are investors within the business? So what are the advantages for them? The advantages for us is, if the company does well, the reputation is going to grow. If the reputation grows, then what is going to happen is, if it is traded on the stock exchange, we can then make profit by selling. Because if I bought a share worth £1 today, and if I retain the shares for, let us say, 1 year down the line or 2 years down the line, and if the company does really very well, that £1 could fetch you 20 pounds, 10 pounds, 15 pounds, whatever, depending on the company. Okay, so to give you an example, Airbnb started as a very small company, but eventually they grew and they did a IPO, which is called as a initial public offer. So they did that. Yeah. So this is just to give you like a like an introduction to what we are talking about when it is share capital. I always do that in my classes, because then you know what it is basically. So it is like a share capital. So when you say share capital, if you see, this is linking to this particular topic because of the consolidated financial statements. When you see the word share capital is nothing but the shareholders, the people, the owners of the business have. Owners is not the literal owners, they are called the promoters of the business. If I have started the business, I am the promoter of the business. But who are the owners of the business? The owners of the business are the people who have invested in the company. Okay, they are the owners of the business. I have only promoted it. I might have invested 50% of the shares, but still I am a promoter and the owner. Okay, so so the owned capital, they don't have to be paid a fixed amount or dividend every year. So that is an advantage for the company, because it is company's choice whether to pay the dividend or not. Okay, within the shares, guys, there is one more type of shares called as preference shares. Preference shares is also like shares. It is shares, but it is called preference shares. The word preference means they get a preference when it comes to paying a dividend. If the company declares a dividend, they should be the first ones to get the dividend. So the company, it is literally the choice of the company whether they want equity shares and preference shares, or do they want only equity shares. It is completely up to them what they want to do. Okay, so it is completely up to the company what they want to choose, how much preference shares they want to release, how much equity shares they want to release. But if they release or if they issue preference shares, then they will be given preference on the dividend. So they will be given dividend before the others. Okay, before the other equity shareholders. So this is the background of the question or the topic that we are going to do. Okay, so you will also come across the word share premium. What is share premium? So if the value of my, like, let us say I said that 100,000 shares I'm issuing for £1 each. Yeah, if I know that I'm going to do very well, okay, then what I do is I can, like Airbnb example I gave. So they know that they will do very well, so they will, or they can, or whichever company, usually they establish first. They don't do the IPO straight away. They never issue shares straight away. They see how the company is doing first. If they sense that the company has the potential to do very well, then they introduce it, and then they put it on share premium. So what is share premium? Is anything which is extra. You gave a premium. What does the premium mean? Premium means you're paying extra, isn't it? So so £1 instead of £1, let us say they are releasing them for £1 50 each. So that means this 50p that I'm paying extra is the premium. All right. So this is the share premium also we need to know. It is linked to the share capital again. So what happens is if 100,000 shares are released, so if they are, so let us say 100,000 shares at £1 50 each, 50p is the share premium. So how would I record this then? I would record within the share capital, I would record 100,000, because £1 is the value of the share, and within the share premium, I will record 50,000. Both of these, guys, are a liability to the company. Both of these, if the company winds down, if it shuts down, they have to return to the shareholders, subject to how much money they are left with. After clearing all the debts at the end, they have to clear the shareholders' money as well, but only to the extent of whatever they owe. Okay, like limited liability. Now this So now I'm going to start with the example. Okay, so consolidated statement of financial position. So when we are doing the consolidated statement of financial position, there are various points to consider. Okay, so what are the different points to consider within the statement of financial position? So first of all, there is something called as purchase consideration. Okay, because I'm buying a company. So first of all, what is consolidated statement of financial position? I will explain once I go over this, and then I will explain what is a consolidated statement of financial position. So different points to consider are purchase consideration, calculation of goodwill, calculation of non-controlling interest, when there is retained earnings on the date of acquisition, pre-acquisition and post-acquisition retained earnings, fair value, impairment of goodwill, goodwill written off after acquisition or impairment of goodwill, intra-company sale. There are a lot of subtopics within this particular thing, and surely if I had not done the background, then I may have been able to cover it. But like I said, what I will do is I will do like a self-recording, and then I will upload them on YouTube for the continuation of the session, because surely we'll not be able to finish everything today. Okay. Now, first of all, what is a consolidated statement of financial position? So this is my example here. Yeah. Now this is an example, guys. Okay, if you want to do a screenshot, I will upload this. So don't worry about it. I will upload. But in the meantime, if anybody wants to do a screenshot on their laptops rather than just listening to me, if you want to follow it, then maybe it is a better option if you want to just do a screenshot. Okay. So first of all, what is a consolidated statement of financial position? So basically, consolidation means coming together, merging two of them. Okay. So why do we do that? Because there are two companies. One company is in a stronger position. The other company wants to sell. So what happens is, so here, if you look at here, you have been asked to assist in the preparation of the consolidated accounts of the Hugh Group. Set out below are the statement of financial positions of Hugh Limited and Daniel Limited as at 30th September 2016 or 26 or whatever it is, X6. Okay. So they have given us a statement of financial position. This is what they have given us. They have given us one company here. They have given us the other company here. What is it that they want us to do? Now, first of all, I want to see here, what is it that they want me to do? The share capital of both Hugh and Daniel Limited consists of ordinary shares of £1 each. There have been no changes to the balances during the year. Hugh Limited acquired 1,920,000 shares in Daniel Limited on 30th September 25 at a cost of 9 is it 9 million 24,000, yeah, 9,024,000. Sometimes you get lost in the numbers. Okay, now here, where are we here? So what is happening here? So we have these two companies here, Hugh Limited and Daniel Limited. One company is taking over the other company. So what happens after that? So the company who takes over is called as a parent company, and the company which is taken over is called as a subsidiary company. So in this case, Hugh Limited is taking over Daniel Limited. So Hugh Limited is called as a parent company, and Daniel Limited is called as a subsidiary company. So what is happening here? So P, or Hugh Limited in this case, is taking over Daniel Limited. What is it that they are taking over? They are paying something against something. So nobody is going to buy something free of cost. So if they buy, what happens is they have to give a consideration against that. That is called as purchase consideration. Okay. So now, first of all, when I'm doing this question, there are a few things that we have to take in mind. So first of all, what is there within this question? So I'm going to see, my first task is always when I start this question, my approach would be, first of all, look at the date, obviously, who is the parent company and who is the subsidiary company, who is taking over who. That is very important, right? In this company, they have, in this particular question, they have very clearly told me Hugh Limited acquired Daniel Limited. So I know that Daniel Limited is the subsidiary company. So Hugh is buying these people. Hugh is buying these people. Okay. So now they're not buying the whole thing. They're buying only partial. So in some questions, they will tell you what percentage are they buying. In some questions, they don't tell you what percentage are they buying. Okay. If they don't tell you what percentage are they buying, then it is, we have to calculate what percentage they have bought. Okay. So what we have to do is we'll have to calculate that. Now, first of all, look at the assets here. Assets are 8184, so 8,184,000. Investment in Daniel Limited is 9,024,000. So whenever you have these three zeros at the top, you have to ignore those three zeros, because in your exam, you have to just work on those numbers which are visible to us. Okay. So here I'm going to see, they have told me Hugh Limited acquired 1,920,000 shares in Daniel Limited at a cost of 9,024,000. Okay. Hugh Limited acquired 1,920,000 shares. First of all, my first task is always to find out what is the percentage of acquisition. So that is my first task, guys. Okay. So first of all, I want to see what is the percentage of acquisition. So I'll have to do the percentage of acquisition. So what is the percentage of acquisition? So that is going to be my first task. Okay. So what is my percentage of acquisition? How do I calculate the percentage of acquisition? So first of all, when I do this, guys, forget Hugh Limited. Do not consider, just ignore the parent company for the time being. Just look at the subsidiary company's balance sheet. Do not look at the parent company for the time being at all. I do not need it right now. All right. When I'm doing this exercise, I do not, till the end, I do not need these people. Okay. I just do not need the parent company. All I need is the subsidiary company. All right. So just keep looking at the subsidiary companies. All you have to look at is this company's balance sheet constantly. I don't have to look at this for the time being till I get to the end of the question. So just keep looking at the Daniel Limited company, because they are the ones who are being bought. Okay. So how much are we buying them? How much is Hugh Limited giving them? How much, what percentage are they buying? Okay. So for that, I do not look at anything right now. First of all, I go to the equity and liability section. I come here first. I come to the equity and liability section. When I come to the equity and liability section, I want to see here again called up share capital. So share capital is 2,400 here. Share premium, I've already explained what is share premium. So this is 960 there. So they have 2,400 and plus the 960 belonging to them. Yeah. Now they have said they have paid 9,024 against 9,000. I'm ignoring the millions here. 9,024. So they have acquired 1,920,000 shares at a cost of 9,024,000. Again, what cost? I don't look at it first of all. First is I always look at what is the percentage of acquisition. So let us look at that. What is the percentage of acquisition? So the percentage of acquisition is how many shares have they acquired? They have acquired 1 million. So I will do it here so that then I don't have to turn the pages again. So the percentage of acquisition. So how do I do that here? Percentage of acquisition is equal to, they have acquired 1,920,000 shares. If you want, you can ignore the three zeros at the end, or if you want, you can keep them. 1,920,000 shares out of a total of, this information is very important for me. Okay. What is the value of each share? See, the value of each share is £1. It means my share capital here, what am I looking at? I'm not looking at any other information. I'm looking at the share capital of Daniel Limited. Okay. I'm not looking at any other information. To find the percentage of acquisition, I look at only that information. So 2,400. So 1,920,000 out of 2,400,000. And if you want, you can multiply that by 100 and we will find a percentage. So when you do that, we get 80%. If you want, you please calculate. So you don't have to, you can ignore the zeros here. And if you just divide this, you will get it as 80%. Okay. What does that mean? So Hugh Limited has taken over only 80%. The remaining 20% stays with Daniel Limited. Okay. So purchase of percentage of acquisition, 80%. So that is always going to be your first task. First step is always, first of all, deciding who is the parent company, who is the subsidiary company. Second step, percentage of acquisition. If the question tells you, good. If the question does not tell you, next step is you have to calculate it. What is the percentage of acquisition? Where do I look for the information? I look for the information from these additional information they have given to us, And also I'm going to look at the equity and the liability side of the subsidiary company. I do not look at the parent company, because I have seen the students get confused always looking at the parent company. Do not look at the parent company, because they are buying them. I don't care what the parent company has right now. I just look at what does the subsidiary company have. So subsidiary company has 2,400. So if I do like a division percentage, I get 80%. That is my percentage of acquisition. Next step is calculation of. So I have been told for this 80% acquisition, they have paid 9024 9,024,000 is what they have paid, which I can also see here. Can you see that here? Look, investment in Daniel Limited. Why have they put it in their um, statement of financial position? Because they have bought it. It is their investment. It is their asset. That is why it is showing in their profit statement of financial position. So against their capital, they have given 9024. They have paid. Okay. Now so what is the next step that I'm going to do? So the next step is I'm going to calculate goodwill calculation. So what is goodwill? Now, why is goodwill required? Now, first of all, if you were to see here, I have paid 9024. So who has paid? Hugh Limited has paid them 9,024 or 9,024,000 against just so much 2,400. That's so 2,400,000. Against that, they have paid almost 900 something. Okay, so it means they have definitely paid something more. Yeah. So I have to calculate goodwill now. Okay, so what is it that we are going to calculate? So calculation of goodwill. So, so what is it that we have to now do? So can you also see there is a, just give me 1 second, I'm just opening a document here on my thing. Yeah. So here I had actually typed one more thing. Let me see if I can bring it up on the board so that then you all can see the answers as well, and I can just show you the working. Give me 1 second, guys. Yeah. No, I can't see that. Okay, just give me 1 second. So let us do the, now here, so called the share. So what all things we have to take care. Okay, so there is equity. So there is share capital here. There is share premium here. And can you see there is retained earnings as well here? There is retained earnings as well here. Okay, so when I do the goodwill, what all things do I have to take into account? Against what? So if the Hugh Limited is taking over the subsidiary company, what all things are they taking over? They are taking over everything that belongs to the shareholders as on that date. As on that date, whatever belongs to the shareholders, they are going to take 80% of that. Okay, so what is it that they will take over then? So let us have a look what they can take over then. So, uh, will we be able to finish everything? Okay, let's try our best. Okay, let's do calculation of goodwill. Now, see, calculation of goodwill, different textbooks have shown differently, guys. Okay, but I have been teaching in a very simple format. If you like it, good. Some textbooks have covered my style, but then I just do it this way. It is much easier, is what I feel. So if you want, you can just do this. But some of you, if you are in a revision stage, guys, I would say, see, think about this if you really want to go over this method or not, because it can become unnecessary. confusing. If you already have learned it in a particular style, then I don't want you guys to get confused with that. Okay, so this is how I tend to do this particular calculation of goodwill. Okay, just give me, I'm trying to open the question from the phone. So sorry, guys, 1 minute. Yeah, so let's look at the calculation of goodwill. Okay. So calculation of goodwill takes into account, like I said, whatever belongs to the shareholders. Now, what belongs to the shareholders here? So for the shareholders, what belongs to the shareholders of Daniel Limited, which is a subsidiary company. Now, what belongs to them? So the share capital belongs to them, the share premium belongs to them, even the retained earnings, the profits belong to the shareholders of the business as well. Okay. Now, considering retained earnings, so you have to be very careful when you see retained earnings in your exam. Okay, I've picked the most, I would say I have maximized the opportunity basically, and I've picked the question which has got retained earnings in it. So when obviously you will get a question with retained earnings in your exam. So when you see the retained earnings, just see if there is any other further information about retained earnings. Yes, I have information about retained earnings. What is the information about retained earnings? They have said at 30th September, the balance on the retained earnings of Daniel Limited was 4,800,000. Okay, so on 30th September, what happened on 30th September? 30th September was the date when they set out below are the statement of financial positions of Hugh Limited and Daniel Limited as at 30th September 26. This is on 26, guys. Okay, and when have they taken over? So this is on 30th September 25. So when they have taken over on 25 September 30th, 2015 or 25. They have operated for 1 year, and that statement of financial position is showing that. Okay. So what is it that I'm going to do now? I'm going to calculate goodwill based on certain things. Anything and everything that belongs to the shareholders of the subsidiary company as on the date of acquisition, percentage of that has to go to them. Okay. So what all things goes to them then? So there are a lot of things which goes to them. All right. So I tried to do that entire document. I tried to upload it, but it is just not working for some reason. I put everything in one document so that you guys could see it visually, but I'm not able to upload that for some reason. Even if I'm trying to upload it, it is just showing partial image. It is not showing me the full image. That is why I'm struggling with this technical things today, unfortunately. Okay, so we will look at this now. So calculation of goodwill. So what is included? So 80%. So what belongs to the shareholders, guys? So anything which belongs to the shareholders, but only 80% of that is what I'm going to look at first. So 80% of share capital. Which company I'm seeing, guys? I am not seeing the parent company. I'm only going to look at the subsidiary company. So Daniel Limited. I'm only going to see Daniel Limited's shares. So 80% of their share capital, 80% of their share premium. Okay. Then we saw that the retained earnings were 4,800,000 on that date. Can you see what is the retained earnings here now? The retained earnings are 6,624. So it has increased. But what happened after the acquisition? We are not going to take that for goodwill. What was already there on the date of acquisition, I'm only going to take that into account. Okay, so the retained earnings have to be split between pre-acquisition and post-acquisition. Okay, so that is called pre-acquisition and post-acquisition and post-acquisition. Okay, I cannot take post-acquisition for calculation of goodwill. I can only take pre-acquisition for the calculation of goodwill. What was pre-acquisition? Pre-acquisition was what was given here, which was 4,800,000. So I can take that. Okay, I cannot take anything after. So post-acquisition, forget it for the time being. Pre-acquisition is all I can take. So let us look at the calculation of goodwill now. So 80% of share capital, 80% of share premium, 80%. Why am I saying 80%? Because they have only taken over only 80%. So first of all, what all things they have to take into account? Their share capital, their share premium, the retained earnings, pre-acquisition retained earnings. I'm seeing RE here. Okay, pre-acquisition. There's one more thing here, guys. Okay, like I said, this is like a full-fledged question. There are more transactions which obviously I could not finish, so I did not take this. So here, there is one more thing that they have said here. The non-current assets of Daniel Limited are comprised solely of land, which had a fair value of 30th September of 9,384,000. The revaluation has not been reflected in the books of Daniel Limited. Now, what is this? So now they are saying Daniel Limited also had a land which the fair value on 30th September when they took over was 9,384,000 and the revaluation has not been taken into account. Okay, what is that now? Let us see. Can you see in Daniel Limited, there is only one non-current asset which is showing at 8,184 or 8,184,000. So the only one that they are seeing in the question is the land, which has been now revalued, and the revaluation value is 9,384,000. So I have to take that also into account because that is a gain. So that gain, the share of that gain also has to be included. That is called as a fair value adjustment. Okay, that is called as a fair value adjustment. So I'm going to take that as well into account. So what is the fair value? So I'm sure, guys, those who have just started, they will struggle with this question. Okay, you may have to stop, watch only purchase consideration, watch only calculation of goodwill. Then when you're ready, watch the next parts. Okay, bits and pieces you'll have to do because it is a full-fledged question. So all you have to remember is when you are doing the valuation of goodwill, what belongs to, how do you calculate goodwill? So that is all you have to see. Okay, so I'm going to show you first of all what is the value of the assets taken over against what have they paid. Then comes your goodwill. Okay, so first of all, I'm going to see what is the value of the assets taken over first of all. Okay, value of assets taken over. So this is what I'm trying to find out. So 80% pre-acquisition, so which comes to, and then I'm going to take the fair value adjustment. What is the fair value adjustment? Fair value adjustment is the land one. What is the land? Land value was 8,184 and now it is 9,384. So I'm going to take that as well. 9,384 minus 9,384 minus 8,184. So this is like a gain. Okay, which comes to, let us see what it comes to. So 9,384 minus 8,184 comes to 1,200. Right. So let us do 80% of all of that. Okay. And then, so there are two ways you can do, guys. Some people do just add everything and just calculate 80% of that. That is also very simple. But because I'm teaching here, I'm explaining for the first time. I'm just writing everything in detail. Okay. So basically what you could have done is you can just add all of them and just find 80% of that. But you have to be very careful on the retained earnings here. So don't take this into account, okay, because this goes into pre-acquisition and post-acquisition as well. So you have to take both of this. So let us take that into account. Okay, So what are we doing here? So we are doing the, okay, so what is the total of the share capital? So let us do all of that now here. Okay, so percentage of, so first of all, what is the purchase consideration paid? What have they paid? Purchase consideration they have paid is equal to 9,024,000, which is what it says in the question. So I'm just putting in thousands here. Against what? Against the net assets. Okay, so what were the net assets? So net assets at the time of acquisition, okay, I'm going to take, so two methods you have, guys. You can take add all of them, calculate 80%, or for the timing, because I'm teaching for the first time, I'm doing separately. 80% of share capital, 80% of share premium, 80% of pre-acquisition profits or retained earnings, and 80% of fair value. Okay, so that comes to, so if I take, or like I said, guys, you could add all of them, just calculate total, just 80% of that as well. Okay, so you don't even have to do like this. So if I take share capital as the original numbers, which are 2,400, share premium as 960, I take pre-acquisition retained earnings as 4,800, and the profit which we just calculated as 1,200. So you can add all of them, guys, and then you can just calculate 80% of that. That will give you the answer. Okay, so let's do that. So there are two ways, like I said, you can do plus 960 plus 4,800 plus 1,200. So that comes to, total comes to 9,360, but they are not taking over the whole thing. 80% of that is they are taking over. Okay, so that comes to multiplied by 80%. So they are taking over worth 7,488. So 80% of that comes to only 7,488. Okay, 80% of that comes to 8,000. So then, but they have paid 9,024, but they are only worth 7,488. So they have paid that extra amount as goodwill. So goodwill is 9,024 minus the 7,488, which comes to 1,536. If I add the three zeros at the end, it comes to 1,536,000 is the goodwill. So this is the value of goodwill. Okay, so what is goodwill? Goodwill is the difference between what you have paid and the value of the assets that you have taken over. How do you calculate the value of the assets taken over? It is the percentage of acquisition that you have to do. Okay, I'm sure I cannot finish everything today, but I am going to continue with non-controlling interest, and I will record the session. I'll finish this question and I will upload this for you guys. Okay, so that then I'm not leaving that in the air. All right. The next part is so the first step is to calculate the percentage. The second step is to calculate the um, calculation of goodwill. The third step is to calculate non-controlling interest. Non-controlling interest. Now, what is this non-controlling interest? Now, if I were to see this in this company, if 80% is taken over by Hugh Limited, what about the remaining 20%? 20% stays with Daniel Limited. Okay, so 20% stays with. So what goes? What belongs to them? So whatever is left over from here goes to them. And there are a few other things which also will be there. Anything that has happened after the takeover belongs to them. But again, 80% belongs to the parent company, only 20% belongs to them. So let us see what all belongs to. That is called as a non-controlling interest. So there are two options again, guys, here. Either I can do straight away 20% of all of this. So let us start doing that. So what goes into the non-controlling interest? 20% of share capital, Again, do not look at Hugh Limited. Do not look at the parent company here at all. Okay. We are consistently only looking at the subsidiary company balance sheet only. If you start looking at the parent company, you will go wrong and all over the place. Do not look at the subsidiary company at all. Just stick to the subsidiary company. Do not look at the parent company balance sheet as yet. 20% of share capital, 20% of premium, share premium, 20% of the retained earnings, because you gave away 80% to them here, isn't it? Out of this 4,800, you gave away 20% to them. But then let us look at this now. 20% of retained earnings. Okay. So 20% of retained earnings. This is post acquisition as well as pre-acquisition as well as post-acquisition both. Now, why is that? Let us see. Pre plus post. Okay. And then they are also going to get 20% of the fair value adjustment. Fair value adjustment. Whatever 80% you gave to them, take 20% here. Okay. So that is as simple as that, because 80% went to them. 20% stays with these people. But when it comes to different things, aspects, then that gets confusing. But if you know what it is, you will master this topic very well. Okay. So 20% of share capital, fine. So I'm going to just use whatever is the number here, 2,400, 960. Okay. So I'm going to calculate 20% of that straight away here. So 20% of 2,400, that makes it 480. 20% of share premium, which is 20% of 960, giving me 192. Okay. First, let me do the fair value adjustment and then I'll come to pre and post. Okay. 20% of fair value adjustment is 20% of 1,200, which makes it 240. Now, retained earnings. I took, for the calculation of goodwill, I just took pre-acquisition. But for the calculation of non-controlling interest, I have to take both. Now, what is all this? First of all, what is non-controlling interest in the first place? So, so when I prepare a consolidated financial statement, I'm going to show you here. Like I said, guys, I'm struggling to show you the actual consolidated statement here. I copied everything, but I'm not able to show you, like I said. So what happens when you consolidate? When you consolidate, I'm preparing one balance sheet for both companies put together. Okay, that is what I'm trying to do. So my assets will be merged. My assets will be merged. My liabilities will be merged. So here inventories, this will get added to this. My trade receivables will get added to this. My cash will get added to this. And there will be only one figure. Then non-current assets, investment will go away because you have already, so this 9,024 gets adjusted with these numbers here. Okay, so you will not show this 9,024 in the consolidated statement of financial position. Equity and liabilities, your share capital, now you will include the parent company as well. But this time you will not include the subsidiary company because you have already adjusted that against the goodwill. Okay, so you will not take that into account. You will not take, so you will only take the parent company at that stage. But you will take the, only the 80% would have been included in goodwill. Why? What about the 20%? Because the accounting equation will not match. The balance sheet is not going to match because you are showing me 80% in goodwill, 20% is still with the Daniel company. So that has to be shown. So the the non-controlling interest needs to be shown here as well. So whenever I get an opportunity, guys, what I will do is I'll share the answer with you. And like I said, I will share the remaining part of the video as well, because I feel if you have not started with this topic, it could be really, really overwhelming, and it could lead to a lot of confusions. But at the same time, for those who have started the revision, for them to be benefited, I will have to do the whole thing. So I will do the whole thing and I will send it to you guys. I will share the link with you at the soonest opportunity. Okay. So what am I doing here? I'm trying to calculate the non-controlling interest. Why am I doing the non-controlling interest? So that then it basically the balance sheet is complete. 80% belongs to the parent company, 20% belongs to the non-controlling interest. Who are the non-controlling interest? Daniel, because they don't have any controlling power now. They are non-controlling. They can't control. That is why it is called non-controlling. What stays with them is non-controlling, which is the 20%. 20% of fair value adjustment is this. Now comes to your retained earnings. Retained earnings, if you remember, there was already pre-acquisition retained earnings, which was so the total retained earnings is 6,624. 6,624. But as on the date of acquisition, this was the pre-acquisition. The pre-acquisition was 4,800. So I gave away 80% to the a parent company. So 20% stays with these people, 20% will stay with Daniel. Now comes your post. They have worked hard after the acquisition. Daniel has worked hard after the post acquisition. So they have made more profits. So the difference between 6624 and 4800 is the post acquisition profit. And what is the post acquisition profit? Let us find out what is the post acquisition profit. So 6624 minus 4800 is 1824. This is what they have earned after the takeover or the merge. Out of this, they have got a right of 20% again. 80% I don't take it right now, 20% only, because I'm doing the non-controlling interest right now. So I'm going to do pre plus post. So basically what I'm doing is I'm taking 6624, 20% of that. Straight away I take, because you get share of both. So if I do pre plus post, 20% of 4,800, 20% of 1824, both put together will give me 1,325. So my non-controlling interest total comes to, so this is 1325, 240. Fair value adjustment I've taken. Have I taken all the numbers? Yes. So all put together, this comes to 2,237. So this is your non-controlling interest, your goodwill, your percentage of acquisition. Okay. So Emma, can we stop the recording, please?